Hello, everyone, and welcome to the Manifested e-learning platform. We continue with the sharing of knowledge in advanced financial management. The topic is advanced financing decision. We, in today's lesson, going to begin on a new subtopic, which is long-term financing decisions. Long-term financing decisions. The syllabus requires us to look at three areas. That is bond refinancing decision, which is a long-term financing decision. We have the lease buy evaluation and rights issues. So we'll be taking one at a time. In today's lesson, our focus will be on bond refinancing decision, which is a key financial strategy for companies that have issued bonds, and it involves replacing existing bonds with new ones. So in this lesson, we will be analyzing the factors in bond refinancing. We'll also answer the question, why refinance bonds? Then at the close of the lesson, we are going to work out a KASNEB Advanced Financial Management past paper question that was tested in December 2024. So candidates, welcome to the lesson. Those are our lesson objectives. By the end of this lesson, you'll be able to explain the meaning of bond refinancing, should be able to outline the factors considered in bond refinancing decision and also reasons why companies refinance bonds. Then you should be able to work out any computational question associated with bond refinancing. So first of all, we define what is bond refinancing. So bond refinancing is the process of issuing new bonds to pay off existing bonds. If a company issued new bonds 5 years ago, it may choose to refinance by issuing new bonds. And the primary goal is usually to reduce the company's interest expenses, because companies that issue bonds are required to pay interest on the bonds. And this is often done when interest rates have fallen since the original bonds were issued. And there are various factors in bond refinancing. So let's highlight some of the factors. Factors in bond refinancing. Factors. So get it clearly firstly, candidates, that bond refinancing involves replacing existing bonds with new bonds. That's the definition. So what are some of the factors in bond refinancing? The first key factor is interest rates. Interest rates. This is the most significant factor, because if current interest rates are lower, the current interest rates are lower, today's interest rates, if they are lower than the coupon rate on the existing bonds, then refinancing can lead to substantial savings. That is a significant factor. The second factor is call provisions. Call provisions. Many bonds have what we call call provisions. These are provisions that allow the issuer to redeem the bonds before maturity. However, before redeeming such bonds, the company may need to consider if there are any what we call premiums or penalties that are associated with such provisions. Call provisions. 3, transaction costs. There are costs that are associated with refinancing bonds. Issuing new bonds involve costs such as underwriting fees, such as legal fees, and other expenses. And such costs must be weighed against the potential interest payments, such that if the potential interest payments exceed the costs associated with bond refinancing, then the company can go ahead and do bond refinancing. The fourth factor is time to maturity. Is a factor to consider. Time to maturity is a factor in bond refinancing. Time to maturity, the remaining time of maturity of the existing bonds, time to maturity of the existing bonds, the remaining time, and also the time or the maturity of the new bonds may influence the refinancing decision. Time to maturity. 5, company credit rating. The credit rating of the company that is issuing the bonds, because an improved credit rating can allow a company to issue new bonds at a lower interest rate. Then finally, market conditions. Market conditions. This is yet another factor in bond refinancing. Market conditions. The overall market volatility, including the investor appetite for bonds, also play a larger role in the ease and the cost of refinancing. So these are factors in bond refinancing. 6 factors. Number 1, interest rates. Number 2, call provisions. Number 3, transaction costs. Number 4, time to maturity. Number 5, company credit ratings. And 6, market conditions. The next question we need to answer in this lesson is why bond refinancing? We need to answer the question why. Why issue new bonds to pay off existing bonds? That's the question we want to answer. Why bond refinance? Why? The first reason is related to the first factor here, which is interest rates. The first reason, key reason, is to reduce interest rates. To reduce interest rates. To reduce interest rates. This is the common driver of bond refinancing. The common driver. The common reason. This is what drives bond refinancing. When market interest rates fall below, when market interest rates fall below the coupon rate of the company's existing bonds, then refinancing allows the company to issue new bonds at a lower interest rates, thereby reducing interest payments. And that can translate to significant interest cost savings over the life of the bond. To reduce interest rates. 2, to extend maturity. To extend maturity. To extend maturity. Refinancing can be used to push back the maturity date of debt. To push it back. And that provides the company with more time to repay the debt, which may improve its cash flow and its financial flexibility. And that is especially beneficial if the company anticipates future cash flow challenges. Extending maturity. We're moving on to the third reason why companies bond refinance is to change bond covenants. To change bond covenants or agreements. That's another reason. Bond covenants are agreements between the bond issuer and the bond holders that restrict certain actions by the issuer. So refinancing offers an opportunity to renegotiate these covenants, potentially improving the restrictive clauses or adding more favorable clauses. To change bond covenants. There are certain agreements that the two parties agree. And mostly these are restrictive clauses that hinder the bond issuer to carry out certain actions. So during refinancing, these covenants can be altered. Now, the fourth reason is to improve financial flexibility. To improve financial flexibility. Bond financing is carried out to improve financial flexibility. Because by reducing the debt service costs, by reducing the interest payments and extending maturities, because we say that is one of the reasons to reduce interest rates, to extend maturity. By doing so, that allows the company to pursue other strategic initiatives. That allows the company to increase its financial flexibility. The money that is saved can be used to do other things. The company can pursue other strategic initiatives such as investments, such as acquisitions, mergers, and so on, to improve financial flexibility. Company can only engage in such strategic actions if it has financial flexibility. So doing financing can allow the company to be more flexible to engage in other activities. We can go on and mention the fifth reason, which is to capitalize on improved credit ratings. To capitalize on improved credit ratings. Now, at the time of issuing the original bonds, the credit ratings of the company may be low. But over time of, say, 5 years, these credit ratings may increase. So if a company's credit ratings has improved since it issued its original bonds, it can refinance at a lower interest rate, because a higher credit rating signifies lower risk to lenders, allowing the company to secure more favorable terms. So these are 6 reasons why companies issue new bonds to pay off existing bonds. 1, to reduce interest rates. 2, to extend maturities. 3, to change bond covenants. 4, to improve financial flexibility. 5, to capitalize on improved credit ratings. So we covered 2 aspects of our today's lesson. We had 3 objectives. The first objective was to define bond refinancing and outline the factors in bond refinancings and to give reasons why companies do bond refinancing. The third part of this lesson was to work out computation question that was tested by KASNEB. And in this lesson, we are going to answer the question that was done or tested in the sitting December 2024 sitting. December 2024 sitting. We are going to answer December 2024 question 4C. Allow me to first rub the board. December 2024 question 4C reads as follows. ABA Limited has a 20-year 14% debenture worth 250 million Kenya shillings, which has been in operation for the last 10 years. ABA Limited still has its book issue cost amounting to 900,000 shillings, being half the total amount originally capitalized. The debenture can be paid off anytime, but the financiers will charge a penalty amounting to 9% of face value. The directors of the company are considering replacing this debenture with a new 10-year 12% debenture with a face value of 250 million Kenya shillings. The issue cost will amount to 10% of gross proceeds. The company is in the 30% tax bracket, and there will be interest overlap for 3 months required. Roman 1, the net cash investment that will be issued or required to replace the existing debenture. Roman 2, the annual cash benefits to be derived from financing the current debenture. Roman 3, using the NPV method, advise ABA Limited on whether or not to refund the existing debenture. That's the question. And you can see from this question, candidates, ABA issued a 20-year 14% debenture worth 250 million. You see the interest rate is 14% and the new one is 12%. The new 10-year, this one was 20 years, this is 10 year. Do you see that? Yes. So the interest rate has gone down from 14% to 12%. So we are required here to candidates to calculate the net cash investment that will be required, the initial cash investment that is required to replace the existing bond. And we read that the issue cost will amount to 10% of gross proceeds. We also read that the company is in that bracket. We also read that the debenture can be paid off at any time, but the financier will charge a penalty amounting to 9%. So there is that penalty of 9% of face value, which is one of the costs, because we have to calculate the initial investment cost. So the first here cost is the penalty, the call penalty of 9%, and it is 9% of the face value. What is the face value? The face value is 250 million. So that's the first element of the investment amount. Then apart from that, we read that the company is in the 30% tax bracket and there will be interest overlap for 3 months. That interest overlap is also part of the net cash investment. That interest overlap is part of the net cash investment, and it is 14% of 250 million. Then we prorate it at 3 months. That will be 3 over 12. Do you have any other course? Yes. We read something to do with the issue cost. We had issue cost. Look at the second sentence. ABA Limited still has in its books issue cost of 900,000. There is that issue cost of 900,000, which is half of the total amount originally capitalized. Then we read the second last sentence there, that the issue cost will amount to 10% of gross proceeds. So the issue cost here will be 10% of the gross proceeds. What is the gross proceeds? The gross proceeds is the face value of the bond, which is 250 million. So those three aspects, those three elements will constitute the net cash investment. That will constitute the net cash investment, the three elements. So here is the answer to part Roman 1. Roman 1, we are to calculate the net cash investment. Net cash investment. Very straightforward candidate, this one. In fact, we begin with the issue costs. Issue costs. So we have issue costs, and since the issue cost here is 10% times 250 million, amounting to, this is just 25 million. 25 million. Then there is a call penalty. Call penalty. The call penalty, reading from which sentence? Let me identify the sentence. The call penalty was 9%. The debenture can be paid off at any time, but the financiers will charge a penalty amounting to 10% of the face value. 10% of the face value. So 9%. This is 9% of the face value, which is 250 million. Do you see that? Yes, 9% of 250 million is 22,500. The next element is overlapping interest. Overlapping interest. Now, overlapping interest, first of all, the rate is, the coupon rate there for the old bond is 14%. It is 14% of the 250 million times, we prorate 3 months. That is 3 months, is it not? 3 months. 3 months. That is overlapping interest. 14%, 3 months. Okay? The company face value, the issue cost, the penalty, the interest 14%. Overlapping interest is that. So we get the amount there, 8,750,000. These three will give us the net cash investment. 25 million plus 22,500,000 plus 8,750. It's total of 56,250,000. That is the net cash investment. That is the gross initial cash outlay. Then we have to deduct some expenses. We have to deduct expenses or deductions. What are the deductions? Look at the question again. We have the call penalty, which will lead ABE to enjoy some benefit, tax benefit. There are tax benefits associated with the call penalty because this is the gross initial cash outlay. This one is the gross initial cash outlay. That is the gross, not the net. We have to calculate the net. Net means we get the gross initial outlay, then we deduct any benefits. So these ones are costs. We are going to deduct tax benefits, less tax benefits. Tax benefits. The first obvious one is on the call penalty. Call penalty. Call penalty. The company will enjoy 30% of the call of 22,500. The overlapping interest, there is a benefit associated with overlapping interest. Again, 30%. Overlapping interest, 8,750. Now look at the question again. We have the issue costs. Reading from the question, the second sentence we read, ABA Limited still has in its book issue cost amounting to 900,000. Okay, that 900,000, that is an amortized issue cost, which will also, the company will enjoy a tax benefit on that. So we have an amortized issue cost, an amortized issue cost of 30% times 900,000. So I'll take my machine and get the amounts. 6750. Then we have 2625. It's 900. It's 270. All these are benefits, so we deduct from the initial cash outlay. So the total benefits is 46,605,000. This is the net cash investment. Net cash investment. So that is Roman number 1, net cash investment. Net cash investment. So that's the answer, the net cash investment to Roman number 1. Roman number 2, the annual cash benefits to be derived from refinancing the current debenture. Look at the question again. The annual cash benefits to be derived from refinancing the current debenture. Now, how do we calculate the annual cash savings? We get the difference between the new cash flow of the old bond and the new cash flow from the new bond. The cash flow from the old bond and the cash flow from the new bond. That's how to calculate or determine, that's the formula for determining the annual cost savings. Annual cost savings. Annual cost savings. Roman 2, annual cost savings. How do you calculate the annual cost savings? You get the difference between the net cash flow of old bond and the net cash flow of new bond. This is equal to net cash flow of old bond minus net cash flow of new bond. To have a saving, then what the cash flows that are obtained from the new bond should be lower than the cash flow obtained from the old bond. So we are going to calculate to determine the two, then we compare, and that will give us the answer. So we have workings. Remember I told you formula is very important. Put down the formula, then work out. So this is the formula. To calculate the annual cost savings, we'll get the net cash flow of old bond. Deduct net cash flow of new bond. You just need two things. So let's work out, first of all, the net cash flow of old bond. Working 1, net cash flow of the old bond. The cash flow. Net cash flow. Net cash flow of the old bond. Now, what will the cash flow constitute? We're going to have the cost, then we deduct any benefits. The cost, we deduct benefits. And the first cost associated with the old bond is the overlapping interest. The overlapping interest. The overlapping interest. So first of all, we have the overlapping. Overlapping interest, we know the interest is 14%, and it's 14% of 250 million. 14% times 250 million. How much is it? Take my machine. That will be 14% times 250. This is 35, is it 35 million? We have 3 zeros up there. 35 million. That's the first element. The cost. That's the only cost that we have. Then we will deduct any benefits, tax benefits. Tax benefits. So the first tax benefit, we have the interest, the tax shield benefit. Tax interest, let me just call it interest tax shield. Interest tax shield. the interest tax, let me call it interest tax shield, and this is just 30% of this interest of 35 million. 30% of 35 million. I just multiply by 30%. That will be 10,500,000. We deduct. This is a benefit. We are deducting, it is reducing the cost. Then we check for any item that reduces the cost, which is the amortized issue cost. The amortized issue cost. We had earlier on calculated the unamortized. Now the amortized issue cost, look at the question. The amortized issue cost is how much? The amortized issue cost. Do you have any percentage? Do you have any percentage? Look at the question again. Yes, look at the second last sentence. Says the issue cost will amount to 10% of gross proceeds. Then in note number 2, we read that ABA has still in its books issue cost amounting to 900,000 shillings, being half the total amount originally capitalized. This debenture can be paid off at any time, but the financials will charge a penalty of 9%. Of 9%. So what is the amortized issue cost? What is the amortized issue cost? We have that information. The issue cost will amount to 10% of gross proceeds. Now we read from the second sentence, ABA Limited still has in its books issue costs amounting to 900,000 shillings, being half the total amount. So that is the amortized issue cost, 900,000. So the tax benefit will be 30% of 900,000. Amortized issue cost, the benefit 30%, 900,000. This is equal to 270. Is it 270 or 27? 270 or 27? It's 27. Calculator. It's 27. 270,000. 270,000 is a benefit. We deduct it from the interest. So how much is it? It's 24,230. 24,230. So these are, it's just 270 here, because you have 3 zeros up there. 24,230. That is the net cash flow of all bond. The net cash flow of all bond is 24,230. Then we calculate the net cash flow of the new bond. The net cash flow of the new bond, I'll go to page 3 here, my page 3. This is the net cash flow of old bond, working 2. Net cash flow of new bond. Now to calculate the net cash flow of new bond, look at the question. We have the interest of the new bond. First of all, we have the interest. The interest rate is 12% times 250 million. I have my 3 zeros here. Then we are going to deduct the tax shield benefit. The interest tax shield benefit is 30% of the interest. How much is it? This is 12%. 12% times 250 million. 30 million 30% of 30 million. 30% of 30 million is just 9 million. It's 9 million is a deduction. Then we deduct any other shield benefit. Amortized issue cost. We have amortized issue cost. Now the amortized issue cost, from the question we read, look at the question. The issue cost will amount to 10% of gross proceeds. 10% of gross proceeds. So we have 30% of 10% of gross proceeds, 250 million times. So 30% times 10% times 250 million. 250 million times 10%, that will be 25 million. 25 million times 30%. 7.5 million. 7.5 million. There are 3 zeros up there. So we get the net. The net will be 30 million. 30 million minus 9 million minus 7.5 million. This gives me 13.5 million. 13.5 million is the net cash flow of the new bond. The net cash flow of the new bond is 13,500,000. So the difference will be the annual cost savings. The annual cost savings, you get the difference. 10,730,000. 10,730,000 is the annual cost savings. Is the annual cost savings, and that is Roman 2. Roman 3, we moved Roman 3 using the NPV method. Advise ABA Limited on whether or not to refund the existing debenture, on whether to fund the existing debenture. So we are going to get the NPV, and we know the NPV is equal to the present value of cash flows of cash inflows minus present value of cash outflows. That is the NPV. So Roman 3, we have to calculate the NPV. We know NPV is equal to present value of cash inflows minus present value of cash outflows. We have the cash outflow here. This is the cash outflow. So we have the cash outflow. What we not have is the present value of the cash inflow. So the cash outflow, we have it 46, this one 46, 605, 605,000. What we need to calculate is the present value cash inflow. The present value cash inflow. So we will have a working for the present value cash inflow. Look at the question. Look at the question. Look at the question. We are going to get the present value of cash inflow. The present value of cash inflow. So we're going to discount this saving. We discount this saving to get the present value of cash inflow. And what is the discounting rate? What will be the discounting rate? What will be our discounting rate? What will be our discounting rate? Let's look at the question. Do we have any clue on the discounting rate? Any clue on the discounting rate? Any clue on the discounting rate? Look at the question. Do we have the discounting rate? The discounting rate, do we have it? We have 14%. Then we have 9% there. That is the penalty. We have the 12%. That is the new face value. Which discounting rate do we use? Which discounting rate do we use? Which discounting rate do we use? Now, we're going to use the after-tax cost of new debt. After-tax cost of new debt. The after-tax cost of new debt. Now, the after-tax cost of new debt, after-tax of new debt or new debenture will be equal to the 12, it is 12%. After tax will be, we multiply 1 minus 0.3. This will give us the discounting rate. So that is 12%, 12% times 0.7. And this is 8.4% will be our discounting rate. So to determine the present value of cash inflows, the present value of cash inflows, this inflow, this saving, we multiply this saving of this present value of cash inflow will be equal to the 10,730 times the present value of 8.4%. How many years do we have? These are how many years? The 10 years. 10 years. So given that the discounting rate is a decimal, this cannot be read directly from the tables, and therefore you are going to use the formula. You are going to apply the formula. So this is 10,730 times the formula is 1 minus 1 over 1 plus r raised to n over r. That is the formula we use, this factor. It can't be read directly from the tables, and therefore this will be equal to 10,730 times 1 minus 1 over 1.084 raised to 10 over 0.084. So when we multiply this annuity with this factor, what do we get? So we go to the machine and punch in these inputs. These inputs will give us 70,708,211. So this is the present value interest factor. 70,718,211. That is the present value of cash inflow, which we need here. This is 70,718,211. That's the present value cash inflow. We deduct the present value cash outflow to get the NPV. 70,718,211 minus 46,605,000. Is that right? Yes. So I get here 24,113,211. That is the NPV. The question is, using NPV. Let's go back to the question. Using NPV, go back to the question. Using NPV method, advise ABA on whether or not to refund the existing bond. And given candidates that the NPV is positive, then ABA should refund the existing debenture. Advice. ABA should refund the existing debenture. Why? Since the NPV value is positive. The NPV value is positive because the NPV value is positive. So that's it for that question that was tested in December 2024. December 2024, we have done part 1, we have done part 2, we've done part 3. Part 1, candidates were to calculate the net cash investment. The net cash investment, and these are the entries. So the net cash investment is 46,605,000. We've gone ahead to calculate the annual cost saving. How do we calculate the annual cost saving? We get the difference between the net cash flow of old bond and the net cash flow of new bond. These are the entries. And we have the workings for the net cash flow of old bond. These are workings for old bond. And here are the workings of the net cash flow of the new bond. 1, 2, 3. Then in Roman 3, you have to calculate the NPV based on NPV to advise on whether to refinance the bond. And we've seen that the NPV is positive. Given that the NPV is positive, then the company ABA can refund the existing debenture because the NPV is positive. Thank you for attending the lesson. We continue to share knowledge in our next session. Make sure to attend. God bless you. Bye-bye.